All right, thanks, Mai. Good morning, everyone. This is a very unique opportunity that has come to the government space. It's like nothing we've ever seen before, I don't think. And so we're going to talk about the energy credits and what you as governments have the ability to tap into this federal money. So here's some of the things that this team is going to cover today related to the energy credits and the opportunities that are there before you. So I'd like to present our speakers today, and I don't know who has control of the slides, but can someone move it? I don't know if I do. Oh, thank you. So today, Carrie Gordon, Colette Gagnet, and Joe Swatsky are going to talk to you about these credits. I've spoke with the three of them many times, and they're very knowledgeable about all the opportunities out there. So if you have questions, go ahead and send them in, and we will ask this team as they present. But for now, I guess I will turn it over to the team to talk about the energy credits. So thank you.
Thanks, Jody. All right. So the Inflation Reduction Act. So this was yet another massive investment from the federal government into our climate economy. Originally, estimates of these incentives from the CBO's office were around $374 billion. They revised those estimates to come out at around 570. However, private institutions reevaluated that, as many of these incentives are uncapped for the next and available for the next 10 years. And so, whereas those reports were initially estimating about 1.2 trillion, we've seen revised reports as of 1.7. And I heard on the news the other day that it was now estimating over $2 trillion of energy incentives available. So there's a lot of cash out there for those investing in various energy properties and facilities. It's just a matter of knowing the rules and how to go in about it. So as I mentioned, once again, another investment into this climate economy. First, we saw the CHIPS Act, the Investment in Infrastructure and Jobs Act, and now the IRA. So for today's purposes, we're going to heavily focus on the production and investment tax credits contained within the IRA. As Jody mentioned, we've talked with several government facilities or institutions, and so we've kind of pinpointed some of the ones that have seemed most relevant, as there's 24 different provisions that could qualify under this IRA. So to kick things off, I'll start off with a polling question. How much was the Inflation Reduction Act originally estimated to cost by the CBO? A, 374 billion, B, 570, C, 1.2 trillion, D, over $2 trillion. Again, this is how much was the Inflation Reduction Act originally estimated to cost by the CBO.
All right, everyone, we do have our first polling question up. If you are here for CPE, please make sure you're answering these polling questions. Make sure your slides box is maximized so you're able to see the polling question. You will click on your selection right on the screen, and then you'll scroll down just a bit and you'll hit submit. Please make sure you are clicking submit after you make your selection so your choice will count. I'm going to keep this up for just a few more moments and then we will continue. Please make sure you're getting your polling questions answered. And also while we're, can you hear me now?
You're still coming in a little soft, May. So right now we're at 85%. So please make sure you check off the button and we'll get to move forward. All right. Moving right along. So as I mentioned, we're going to be focusing on the production tax credits and the investment tax credits contained within the IRA. So production tax credits at a high level are based off of the energy produced per kilowatt hour. And so depending on the type of facility that you're installing, be it solar or wind or other properties, which we'll get into, that rate could vary. Similar on the investment tax credit side, on the production tax credit side, it is a yearly tax credit that's available to you for the next 10 years. The investment tax credit is based off of the energy property that you invest in. And so this would be a one-time credit as opposed to the annual qualification on the production tax credit side. So, and this is based off of the cost of the energy property you're placing in service. I'll note that in the for-profit space, the investment tax credit reduces the tax basis. However, within the IRA, for those in the low-income housing area taking part of those credits, there is no basis reduction for purposes of calculating those credits. So it is important to understand just, I guess, who owns the property and understanding other impacts surrounding these. All right, so again, the investment and production tax credits. The investment credit starts at 6%. If you're paying prevailing wage and meet a prevailing wage and apprenticeship rules, you get that at 30%. And why do you care? You're a tax-exempt org. Tax credits have never really been available for you. Within the IRA, two new code sections were added, 6417 and 6418. So depending on the owner of the property and how it's structured, tax-exempt organizations are eligible to turn these credits into a direct pay. And so what that means is you would essentially file that you're claiming these credits, you're electing direct pay, and it's treated as an overpayment of taxes. Since you have no tax to attribute this to, you get that cash back. So I like to think of the investment tax credit more like a rebate where you've spent the money and now you're owed a portion of that back through this program. On the production side, again, the rate varies based on the property being placed in service. It's also eligible for direct pay. Granted, we've seen some people where they'll put it into a partnership with certain financiers to kind of try and get that money up front. In that case, 6418 allows you to easily sell these credits if you're eligible. And we'll walk through the eligibility requirements there for that one. All right, as I noted, there are a ton of credits available in different energy incentives. So the ones that we're going to focus on today are Section 30C, the Alternative Fuel Vehicle Refueling Property Credit, Section 48, that Energy Investment Credit, 45 is the Production Credit, and 45W is the Qualified Commercial Clean Vehicles. And last but not least, Section 179D, the Energy Efficient Commercial Building Deduction. Again, Joe will go into more detail about why a tax deduction is now relevant for tax-exempt organizations. So how do we go about claiming these credits? It's really about coming together with various teams. It's not just your accounting team, but it's understanding, what are your capital improvements? It's getting the facility engineers and the design teams involved and really understanding what your CapEx plans are and what those budgets are and understanding what makes sense, right? So it's not just a typical accounting or tax problem. It really is a project that we're coming together to work on. And that'll be extremely important when we get into this documentation and verification aspect, as there are different ways that we can increase that credit and that incentive back to us, as long as we have that documentation in place. All right, next polling question. Do you have new construction or major capital improvements earmarked for the next 10 years? A, yes. B, no. C, maybe trying to find the funding. Oftentimes when we've talked to different government entities, there was a plan for solar. We'd like to be more sustainable or reduce our reliance on the grid. But solar is usually the first piece that comes out of the budget, right? As just cost increase and labor increase, the project goes on. It's usually the low-hanging fruit that gets scrapped from the budget. But with some of these incentives, we're seeing it being brought back onto the table. And that's across the board, not just in solar, but various different properties, which we'll get into a little bit more detail next.
Hello, can you hear me okay?
I think we're looking for a few more folks to respond, and then we'll move on.
Hello, can you hear me okay?
You're still pretty muffled. And so another thing that we're seeing, especially in the community college space, they have 10 years of a backlog of CapEx projects that they're trying to figure out the financing for. And so one of the things that we discussed was really, getting that initial funding up and running, it really is, some of these incentives will help fund future projects just based on the time lag associated. All right, so getting more into the weeds of the investment tax credits. Section 48. So if you are investing in any of the equipment listed here that produces energy from alternative sources, you will be eligible for a tax credit. So that's solar, wind, geothermal. We're seeing a lot more evaluations of just geothermal HVACs going in. We've also talked with certain water districts that have microturbines that are helping to offset their current utility needs. Combined heating and power systems, which are generally energy agnostic, depending on where that's coming from. So that's something that just as you're updating buildings or building new buildings, you might want to consider. Equipment that recovers waste energy, typically we see that in the industrial space. Energy storage, so the batteries associated with solar, wind, a lot of these other renewable energy properties. Biogas and microgrid controllers, we are seeing a lot of those systems go in. And so we have, one of the clients that we talked to was actually a farmer in Southern California where the utility company told them they weren't going to give them power for 6 months. So they've got to figure out what they're going to do for half the year. And so looking at these microgrid systems, it really is taking them off the grid so that they can maintain power for their year's worth of production. And last but not least is this electrochromatic glass. And we'll get into a couple of these details going a little bit further. But the electrochromatic glass, that's the glass that fogs up when the light hits it, kind of increasing energy efficiency within your building. So you've invested in the property. Now, how do we get this credit? How do we calculate it? And so we look at it two different ways. We look at it from what is our actual cost and also what is our percentage. So from the cost side, which might be new in the government space, in the for-profit space, there's a bunch of tax code that provides what our unit of property, our unit costs are. And so it's not just taking the invoices for some of this property, but it's looking at the various systems, figuring it out, how far off the grid we're going to see if interconnected property qualifies, if our distribution systems are eligible. There really could be quite the net to throw depending on the design and build that's coming out. From the percentage side, the base credit starts at 6%. If we're paying prevailing wage and meet an apprenticeship or in higher apprentices, we get to this 30%. Now, from a state and local government perspective, I know on the federal side, generally you're paying prevailing wage. So if you're already paying prevailing wage for any of these capital improvement projects, you get to that 30%. There's also an exception to that rule. So if the property that you're installing produces less than 1 megawatt of electrical or thermal energy, you're deemed to have met the prevailing wage and apprenticeship rules. And so that gets us to the 30%. And I'll go into these different, amplify them in a little bit more detail on a later slide. The next is domestic content. So if you can find domestically sourced property, electrochromatic glass is generally produced in the US, you get an extra 10%. So once again, if we meet prevailing wage or that 1 megawatt exception and domestic content, our credit back is 40%. If we're located in an energy community, there's another 10% to be had. And the energy communities are defined by coal mine closures, the surrounding areas, and then certain census tracts. There's actually a Department of Energy map that you can go and search for your address to see if you fall within those areas. And last but not least, if for certain solar and wind projects in low-income areas or low-income housing projects, you may be eligible for an environmental justice allocation. It is an additional application that you have to go through the Department of Energy to request, but that could be another 10 to 20%. So depending on your project, if the cards fall correctly, you could get up to 70% of your overall investment in this property coming back. Now, these credits, they apply to property placed in service post 1/1/23. So if you started construction in December of 22, but you didn't turn the lights on until January 2nd of 23, that property is eligible for a tax credit through direct pay. And I will say, as far as pulling these credits, we've gotten one that's almost hit that 70%. A low-income housing project that we're seeing up in Boulder. They're in an energy community. They're paying prevailing wage. They take part in federal voucher programs for the low-income housing, so they're eligible for the environmental justice allocation. And so through all of those, we're seeing them come out around 60%. However, the domestic content is really what's holding them back, because domestic solar has been a little bit tricky to either get your hands on or afford, for that matter. There's still a premium associated there.
Colette, before we move forward, we should state, that recently both the Department of Labor as well as the IRS have issued guidance on prevailing wage and apprenticeship requirements. Mm-hmm. We're trying to grapple through a lot of the changes therein, but the shocking point to this is historically prevailing wage, which we talked to the idea of Davis-Bacon, but historically the Department of Labor used a 30% average. In other words, they would take a poll within a jurisdiction. They would average, the 30% top people and, come to a prevailing wage number. They have now modified that to 50% of the reportees, they will average on that basis. So most people are expecting that this will dramatically change what prevailing wage is. And being new and not having the Department of Labor actually issue any reports on this area, it's raised a lot of concerns, and most people are saying, we thought we were paying prevailing wage. We're comfortable with prevailing wage. We've always done it. And the pencil may drop when you see the revised number. There's makeup provisions and there's, let's call it safe harbors, that you can do to come back to that status, paying prevailing wage. But it is a good question mark of which everybody's saying, we don't know right now. And they're asking for the Treasury or the IRS to give additional guidance. What happens if? and is there something the IRS is going to do that, we're not planning on today?
Thanks, Gary. And I want to circle back on the energy community. Also, brownfield sites also qualify as an energy community. So just something to make note, the DOE's website is primarily for those coal mine closures and the census tracts. But if it's a designated brownfield, you're also considered in an energy community. In the state and local government space, if this property is funded through municipal funds, there could be some restricted amounts, which Carrie will get into a little bit later. And so I'll let him walk through that later. So the types of property that qualify. Solar. Hopefully most of you have heard of solar panels and whatnot before, but it qualifies if you are using it for electrical production, water heating, with the exception of swimming pools. So I guess the swimming pool lobbyists really failed to negotiate that, and for illumination. So for example, we have a rec center here in Denver that, they're looking to put solar panels on top, and it will be for heating some of the water, but primarily for heating the water in the locker rooms versus the actual pool. And so there is a more detailed analysis that has to be done just to kind of see, is all the electricity, is it going specifically to certain water pumps versus the ones associated with the pool? But it is something to take note. If you have a pool and you're looking to put solar to heat it up, apparently that's a no-go. Another one that we're seeing more are actually these mini wind turbines. And so there are different credits available, a couple different definitions on the onshore and offshore, but it's really kind of based on your facts and circumstances. Another one that we're seeing a lot of is geothermal. Or Carrie, did you have any other comments on the wind?
What I was going to say on the wind is, that picture was a nice presentation of, how people are combining things together. So it shows an example of solar panels as well as mini or small wind turbines. The question always comes about, is, how do I do that calculation? Do I actually get to different credits? And the answer is yes, because each one is delivering an energy product. So your turbines are creating electrical power as the wind blows, and your solar panels are creating electrical power as the sun shines. So the combination units of as demonstrated herein shows, that some cases, parties are able to, have two different energy properties with two different credits and able to utilize both in their facility. I've worked a lot in wind, and it's always interesting, where the windy areas are. We all think of Texas and Oklahoma as a very windy area. The reality is that the closer you're to the coast, the more wind, the fluctuation in wind occurs, because during the daylight hours when the sun is shining, the wind is heating up the ocean, and it causes winds to come off that ocean to drive wind turbines. In the night hours when the ocean, is cooling down because of the lack of sun, the wind, is going back to the ocean. So those are, things to at least, check with your engineering teams and others, to really understand your wind content, because some cases you always think, oh, it's windy here, but not often. Well, the reality is, you might find yourself in the ability to claim something, but justifying it economically is really where, parties have some trouble.
And that's a good point also, that combined system, because the microgrid controller, the controller alone, isn't going to do much. That you do need another component of energy and potentially battery storage associated with that. So that's where, you know, you're looking at the 3 different properties, you're looking at their systems associated with them, determining which bucket of cost they go into, and then their separate percentages are being evaluated. I will note that, you know, for battery storage, if that is connected to solar or wind, you might be able to extend that environmental justice allocation to those properties as well, because they'll be considered part of the solar or wind system that you're installing. Oh, wrong button. There we go. All right, so geothermal. So this one largely depends on if you've got the right space and the right soil to dig a hole. But we're seeing a lot of this across the country, actually. You know, there was a town hall that we were working with that it was due for an updated HVAC system. And in doing our modeling, you know, that original HVAC system was going to be roughly $4 million. The increased cost of converting it to geothermal was another $800,000. So at $4.8 million, that entitled this particular building and in County City to qualify for a credit upwards of $1.2 million. So that credit will more than cover the increased costs of the geothermal, not even taking into account the energy savings they'll experience long term. But then that money comes back to them for future projects or whatnot. So far, we haven't seen anything restricting the cash back when we think about restricted funds and whatnot. And so it is just, it's cash back that, you know, the government entity is able to use as they deem. Let's see. I'll let Carrie cover fuel cells.
All right, fuel cells. You know, fuel cells have been around for a very long period of time. Some people immediately went to the use of fuel cells and others have not. It really is an economic system that macroeconomic system where you have cheap natural gas. You know, it is driving this, you know, fuel cell implementation. A fuel cell does not act as a battery system. You know, it really requires the flow of natural gas, you know, for the fuel cell to convert the electrical, let's call it, the methane itself into electrical power. And it does it by, you know, passing the gas across a series of let's call it filters and the like, where it breaks apart the methane and actually creates the electrical charge. Because of it operating from an entirely different system than the grid, a lot of hospitals and, you know, other facilities that need consistent electrical power are considering the fuel cells, because, you know, the gas system runs off of pressure, where the pressure is usually located in that system a long distance away from where the electrical grid is. And so you could have electrical grids go down in an area and the fuel cells stands by and operates, you know, because it is not reliant upon, you know, the electricity that is coming from the grid. It's relying upon the natural gas. So it's a, you know, it's a great consideration. The fuel cells, like the solar panels, have dropped significantly in costs. You know, so some people, you know, originally dismissed fuel cells because they thought it was expensive, but they've all dropped in price. You know, I'll say I've seen, you know, a 50% reduction in solar power, you know, over the last 10 years. I've seen about a 40% reduction in fuel cells. There is the one requirement, you know, that, you know, it must be greater than, you know, a half a kilowatt of electrical power. You know, some of the bigger systems, you know, just look at that. is a nuisance item, but the reality is, there is a requirement because the way the statute is written that, the cost of the fuel cell cannot exceed a specified amount per half kilowatt. And so it's something to at least give consideration to.
Definitely. All right. Next up are the combined heat and power cogeneration. And I think we have a related question there. So hopefully we'll get to your question as far as examples of this combined heat and power. So Carrie, I'll let you go for that one as well.
Okay. Combined heat and power systems also is a very old, cogeneration is where you take one form of energy and use it for two separate purposes. So most of the common arrangements is where we're using the electrical generation turbine, and taking its heat and then taking off the waste heat of that system and re-employing that waste heat in another purpose. It must be either for thermal capacity or for mechanical power. So some of the modern turbines that we are seeing, people manufacture are taking these combined heating systems naturally into the manufacture of that turbine. So, the manufacturers are changing because they say economically, these are big dollar amounts for a turbine, and we're trying not only to recover all the thermal capacity that turbine would create, but also, to the extent that credits would be available for that party, that they can maximize the credits and lower the cost of their units. So economically, the business manufacturing capacity groups are all saying, okay, we need to work on the same basis as the parties that are thinking economically for the tax benefits that they do. And so the systems are changing, so we're going into a new form of historical gas-fired generation turbines to capture all the thermal capacity. Historically, it was always the coal-fired plants that, had combined heat and power or cogeneration facility because they were trying to capture all the thermal capacity off of that system they possibly could. So it allowed, I always refer to it as, the combustion unit to maximize its, thermal capacity across many different turbine units. So they were able to capture, it as it went across many different forms of turbines. The modern natural gas systems are created to actually create a high level of power by spinning the front end of the turbine very fast and the back end of the turbine very slow. So think of it economically as I go across, and physically, as I go across that turbine, it cools down, the thermal capacity, but I'm able to, by different motors or different systems within a turbine, capture all that energy power. So one of the benefits here is the less fuel I use, the bigger, impact on the environment as well.
And we've seen where there's a university in Alaska that actually, a lot of their electricity is coming from, they have a coal firing plant, but they use that steam throughout the entire campus for the electricity. And so, alrighty. So next one being the waste energy recovery.
Okay, this is, the more modern version of what was combined heat and power. One of the things I didn't discuss on combined heat and power, there is a 50% requirement of efficiency, the system, 60% requirement of efficiency of the system, which that efficiency equation is based upon two sources of fuels or two fuel feeding two different units. So if I put it together as a single unit, do I reach a 60% or greater efficiency on the combined unit that I would have had on the two separate units? Likewise, there's a 20% balancing factor. That 20% of my power must come from either be utilized by a thermal capacity or a mechanical capacity. These rules were very complex, very troublesome to get through. And so the waste energy basically separates that down into a simpler arrangement. And I'll say boldly enough that it should just shut off combined heat and power. There are some reasons for parties still need to get back to combined heat and power because the waste energy provisions didn't give them what they were looking for as much as the combined heat and power system would. So the waste energy basically has really one rule, that it must be greater than 50 megawatts of hourly production. So that's the big component, that people are looking back to and saying, well, I can't get to that number, but could I get to it under combined heat and power? So that's the balancing act between these two systems. But waste heat does not really require, it to do anything but be used in electrical generation. That's the key thing, is I must get to electrical generation. Whereas before I had both the requirements of electrical and thermal, generation or mechanical. So these are two provisions, and I always tell people to make sure you understand all the requirements to qualify. Look at both, look at them, in sequence to each other, and pick the best system for you.
Fair enough. All right. So last but not least is the electrochromatic glass. Again, it's that glass that fogs up when the light hits it. It's something we're actually implementing in our Fargo headquarters. But a little bit closer to home, there's a community center in downtown Denver that is, expanding their footprint. And so they're looking at this glass, and the standard cost for the glass that they were implementing was around $1.3 million. The electrochromatic bid that they got was going to be closer to 1.7. However, once we do that analysis and getting that cost really maximized for that cost base, their potential credit is going to be closer to $800,000. So again, it more than covers the uptick, that premium in this electrochromatic glass, and also will help with heating and cooling and energy efficiency going forward. So in looking at any of these properties, when you're looking and you're working with your facility team, it might be going back to your architects and your engineers just to see what is available, what makes sense. This same community center was looking at some solar panels, and they just couldn't get the numbers to work. Even with the incentives, it might not always work out how they need it. But there is this modeling exercise that that you should do prior to obviously making those decisions. So,
can I add on an example here?
Go for it.
The first time I saw electrochromatic glass used was for a very odd reason. I consider it odd, but historically, the conference room of one client, they were doing their board presentations in that conference room, and will tell their future, and they had many leaks to the public world because for whatever reason that was a confidential meeting within a conference room, all of a sudden got in the public knowledge. So because of that, they went to electrochromatic glass to basically keep someone from videoing their conferences from the outside the window, to show what was going on in the boardroom. Now, whether that was true or not, I do not know. But I'll say they put in electrochromatic glass, and the temperature, efficiency in that room went dramatically. It went dramatically up just because all of a sudden they thought they were doing a security approach where they'd have instead of pulling down shades, they did it with the glass, and they realized how big of an impact it had on that one room. They changed and put it to all their building, so that anybody at a touch of the button could shade the room, or it could be electronically controlled where it would automatically shade the room. This is a good example in this picture where someone wishing to look outside clear, it doesn't look like a clear day, but anyway, look outside through a clear set of windows is available because, that party likely turned off that for those windows.
All righty, on to our third polling question.
Colette, sorry, go ahead. You read the questions first, and then I'll ask some questions that have come in.
Are you investing in a renewable energy property? A, yes. B, no. C, maybe. Trying to find the funding. As mentioned on an earlier slide, typically these items are the low-hanging fruit that get cut from the budget to try and get a building done. So the purpose of these incentives is to make them back on the table and hopefully a little bit more beneficial through some of these incentives. Jody, do you want to?
Yes. So would any of these credits be allowed if you're buying an existing solar system that's owned by a third party?
So I don't know. I'm going to let Carrie kind of weigh in on this one. But my understanding...
I'm happy to weigh in. That's an interesting question.
It is an interesting question. Go for it, Carrie.
Well, ultimately, there is a basic definition in the tax credit that it must be your original use. Original use is the same as new. In other words, I must be the party that is the first party to actually use the property. There are situations you can do where it is actually on someone else's building, part of the property, that you could enter into an agreement that you technically own the property. And it's a technical determination who actually owns that property. We're going to get into this in the monetization sections, discussion. But, is there a way that you could get to existing solar panels or existing assets and make them new again? There's a very favorable rule under the Internal Revenue Code that is referred to as the 80-20 rule, which simply says if 80% of my basis in the asset is new and 20% of the market value of the existing assets could be met, then I would qualify the whole system as new again. The 80-20 rule is used usually in large build-outs, where somebody is going into something and doing significant work to bring an asset into the 80-20 test. The most common I use is, you see it used, is something like a rebuild of solar panels or rebuild of wind turbines, where the wind turbines, like the solar panel, have gone through significant changes. And so I've had clients that go into a large wind farm, and instead of instead of 20-meter blades, they're going to 30-meter blades because they're bigger, they catch more wind, they drive more power. So they're not changing much in the wind farm itself, except they're raising the tower to handle the additional length of the blade, getting it where the tower I mean, the blade didn't hit the ground. That's good decision. So they're adding more tower to it. Likewise, they're adding a different level of turbine because the additional power to that turbine allows it to spin faster. And because of that, we get, could qualify them under the 80-20 approach to make it new again. So the simple answer to your question, can I get to somebody's used property and make it new again? Facts and circumstances.
All right, one quick one. An area with a decommissioned nuclear plant, is that considered an energy area? Or maybe not a quick one.
That's coming into, in other words, environmental, the statute was written to coal plants specifically, but because that area may be under EPA designation as a Superfund site, it's a very specific designation by the EPA, you could get to that approach, so I mean, it's definitely something to get an understanding of really what restrictions are there on the site. Because if you're walking into a historical site that is a brownfield site that hasn't been reclaimed, you're going to do a lot of work to get it to that point of being able to be used. And if that's the case, would you have enough time to get it placed in service, the tax definition of operational, to meet the credit requirements?
Alrighty.
All right.
So moving right along. So we, thanks Carrie for the inputs on the energy property. So once we've invested in one of those properties, there's a couple of bonus amounts that we want to make sure that you're aware of. Treasury has actually done a pretty decent job of getting guidance out timely. We've received a lot of it over the past year for the different areas. As Carrie kind of alluded to earlier, the prevailing wage and apprenticeship rules. So those are heavily defined by Davis-Bacon. However, we don't have the weekly certification reports. We don't have that requirement in this space. However, the Department of Labor, like Carrie said, issued 800 pages that say, we think we're doing great on prevailing wage determinations. And so we're just going to make it harder to qualify it and potentially, potentially make it harder for everyone. There is that 1 megawatt exception. So another thing to consider, but again, being, state and local governments, you may already be adhering to prevailing wage from state level, which are generally higher than at the federal rate, or, they're a little bit ahead when the Department of Labor can catch up to them. So, but recently issued guidance on the wage and apprenticeship rules. So from there, they also provided a good effort exception for the apprenticeship rules. So I think it's 1 in 4 of your laborers needs to be a qualified apprentice or an apprentice that's part of a program. To do that, it's, showing that you've reached out to the qualified programs, you've given them time to respond to you. You have to show that even if being denied, you looked at more than one program. And so it is documenting kind of the ask for an apprenticeship and either being denied or not responded to. Shows, so you want to document that you at least tried. If you have to follow, if you're, not currently meeting these prevailing wage and apprenticeship rules. And these are important because not only does it get you to 30%, the next 2 bonuses are also there. If you meet prevailing wage or one of the exceptions, then the energy bonus and the domestic content are at 10%. If you do not meet prevailing wage, those 2 bonuses are reduced down to 2%. So the prevailing wage and apprenticeship rules are pretty important. It was the main focus as part of this act that, it would create good paying jobs within this space in addition to kind of a cleaner economy. So again, the second is the energy community bonus. That one is largely based on where you're located. Again, it's the DOE map that you're going to go back, look through. either that or a brownfield site. As Carrie mentioned, it's heavily reliant on coal mine closures in those adjacent areas and certain income tracks. Domestic content. So this one, we received guidance. And so what it's basically saying is it's going to look to, the steel and iron components of the energy property, as well as to where it's being manufactured. So if it's at least 40% manufactured in the US and has domestically sourced iron and steel components, it would qualify for this domestic content bonus. Now, there was also some language as a potential exception or a safe harbor to meeting this rule. However, we're still waiting on more guidance to see what that exception looks like. And then last but not least, that low-income community. So it is defined by, the low-income community is defined by the new markets tax credit. And so there is another map that you go and search the address to see if you're in one of those communities. And then depending on the project where the solar or wind is being installed, there is that potential for another 10 to 20% of the credit. So, Carrie, I didn't know if you had anything else on these particular aspects of the credit.
Yeah, I mean, you know, as Colette and I have, let's call it, many of these rules are brand new. I mean, literally within the last, 2 months, all during the time that, our industry is trying to do what we refer to as the tax return filing season. So to the extent that you reach out to someone and, wish to talk through these in detail, it is something that, I'll honestly say, give us some grace. I mean, they're very burdensome rules to read. I've sat down and read through, the apprenticeship and Department of Labor's Davis-Bacon updates. Those are hard documents to read through for, I'll say a combination of 200 plus or 300 plus pages, big documents of which, a lot of it, is giving the flavor of what, that the authority that the department has in this regard. And sometimes those flavorable statements, are hard to read through, kind of saying, why did they make this statement? And then you get into the document and say, wait a minute, I have to go back to what they said above. So they're much, let's call it, very much something, to be considered, not dismissing any of the authority of them, but they are new. They're, all these are, well, let's call it, all these are been issued since December of last year.
And it is a big effort on the government side, right? It's not just Treasury and the IRS, like it is the Department of Labor, it's the EPA, it's the Department of Energy are all coming together to collaborate on these rules because the act requires them to be involved and work together to issue this guidance. So regarding prevailing wage and apprenticeship rules, in talking with our internal payroll folks who actually do Davis-Bacon tracking and whatnot, the first step that they recommended was really reaching out to your contractors and your vendors to figure out, do they at least have that base level information that's required under Davis-Bacon? Are they able to generate, a couple of reports that essentially get you there to identify where any gaps in the data might be that would signify it? It's not the weekly certification reports, but just understanding what information's already available and easily pulled, and then kind of building out what the additional information is going to require. It's the tracking of it is going to increase costs just because it is, another level of administrative work that they're going to be looking into. So, All right, so those are, in summary, kind of your renewable energy investment tax credits. Two other investment tax credits I wanted to mention were the clean vehicles and the refueling infrastructure credits. Now, these, we've heard from some folks in California that California issued some rules that they have to completely convert their fleets to EVs, which for many of the water districts, the heavy duty vehicles, it's just, there's not currently an option on the market just yet for them. But it's section 45W of the code. Under 14,000 pounds, you get up to $7,500 per vehicle. Over 14,000 pounds, it's up to 40,000 per vehicle. And I just want to make a note here in case you've evaluated the tax credits for individual vehicle or personal EVs. The credit works a little bit differently in the sense that there are a lot more requirements regarding domestically assembled, certain restrictions on batteries associated with those personal vehicles, whereas the commercial fleets don't really have those restrictions. It really is, it's looking at, it's really evaluating kind of the purchase price, the weight of the vehicle, and understanding, where you kind of fall out under those caps. On a similar, I guess on the electric fleet as well, we were also talking to some community colleges that looked into it from, a patrol security, campus security aspect. And sometimes it just doesn't make sense. They have to sit idle in a car for hours on end, and that just drains these batteries. So they're not quite there yet. So it's been some trial and error on, in some of the different areas, but it's all things to consider as you go through here. And so, all right, so in addition to getting those fleets, there's also building out the EV infrastructure, so the refueling station. It's under 30C of the tax code if you're having trouble sleeping at night. And it changed a bit from the previous credit in the sense that it has to be located in low income or non-urban areas. Once again, that low income area is defined by the new markets tax credit. There is a map out there, a .gov map, that you can go and look to see if you're in the respective area. The percentage is either 6 or 30% if you meet prevailing wage of the cost to build out that unit, capped at $100,000 per charging unit. Now, we're not exactly sure what a charging unit consists of. Is it a whole row of them? Is it, the ability to charge one car, 2 cars? We're still waiting on, refined definitions for that particular piece of it. Carrie?
One of the things that, people are working on or considering in their charging units is the ability, to do something similar to, let's call it what we're used to in gasoline fueling stations, where, it is one unit charging the left side and the right side. Because of that, it has additional costs. They're exceeding the $100,000, but really it's 2 different ports that are actually being used simultaneously from the system. That's that's a question that we do not know at this point, what the Internal Revenue Service will give guidance over. But you can see, the thought process. If I have to go into an area and start building out a charging station from ground zero, as opposed to working in a existing gas station, we'll call it gasoline station, be specific, that I'm going to have a lot of costs. I'm going to have a lot of costs to set that up, to get the infrastructure in place, you get the parking lot and all that, in place to have it to the charging station. Will that all qualify? That's the ultimate question people are trying to grapple with. If I put a top or a cover over that unit so somebody can charge their vehicle without being rained upon, or let's call it having the sun beat down on them while they're trying to do it, does that qualify? Yes. So these are still open-ended questions of which people are hoping they can get attention from the Treasury to give them additional guidance.
All right. So with that, we'll talk about production credits next, but first we have our fourth polling question. Are you looking into converting your commercial fleet to electric vehicles? A, yes. B, no. C, maybe. So with that, we have one question on the commercial vehicles regarding a bus. It is capped. If it's over that 14,000 pounds, the credit is capped at $40,000, but there's still an analysis to be done as to, how much of that 40 that you would get. My understanding is that commercial vehicles over 14,000 pounds are significantly more expensive than that 40K, but it is something. And then I think we have another question regarding an air conditioning cooler system, Carrie, that I'm gonna pitch over to you. We're a large school district in North Dakota, and we'll be installing a new air conditioning chiller with ice storage with the energy savings price. Will it qualify for one of these tax credits?
What they're opening up the question is, the battery system itself. Let's call it. There are multiple questions that are running through my head on this unit, but I think I know the unit you're talking about. But the battery storage system is thought of historically as electrical powers, electricity going into a battery unit. When the statute was recently revised, it added in other storage capacity, including thermal capacity. So your creation of ice, in that unit, is a separate unit to itself. And it is acting as a storage unit because during some times of the day and night, you're able to create that, thermal capacity to be used in your system, for future use. So, everybody knows, electrical power during the overnight hour where nobody's up running their lights, running their air conditioning, or let's call it less use of air conditioning and the like, the economics of the electrical power drops significantly compared to 2 o'clock in the afternoon, where everybody's using electrical power, tapping into the system. And so, the utilities are able to change the pricing of electricity overnight versus peak hours where they're really having to add on additional capacity to, deliver all the power that's necessary. So to answer your question, sorry for the long statement, but I'm giving a long statement because I have to teach, is ultimately your battery storage system that is creating an ice storage capacity would qualify as the storage unit itself. And because, that is meeting the definition of a storage unit. The rest of your system qualifying as under one of these other provisions, I don't have enough information to get to that question, but definitely with all the things we talked about today, something to go back and look at and see, is there some other component within that system that I could separate as a separate unit of property and have it qualify?
Fair enough. And then we're waiting for a couple more responses. There we go. Before we move on to these production credits, Carrie, there's one more question. Are hybrid electric vehicles eligible for the electric commercial fleet incentive?
No.
Fair enough. All right.
Let's put it this way. Could you get to a qualified hybrid vehicle to meet all the other tests? I just haven't seen one qualify yet. As Colette addressed, there are so many restrictions over the EV vehicle, that everyone that I've looked at to see, could I get a hybrid to qualify? And it's just not making it, because the main issue there is that the statute is truly written to plug in vehicles, and hybrids are usually not plugged in. Not saying they couldn't be plugged in, but the way they're manufactured is not for plug-in purposes.
Thanks, Gary. All right, so we had a lengthy discussion about various investments. Now, to the certain extent that you have maybe a larger solar array field, or even some of those water districts with the micro turbines that are producing hydropower and selling it back to the grid, you do have to sell it to an unrelated third party, but you could be entitled for these production credits. There is some interplay with Section 48, so you can't claim an investment tax credit and a production credit on the same property. So that's just something that, again, if you're looking at both, you want to make sure you model it out to see what makes sense. Now, the production credit is available for the next 10 years. So this is something that would be calculated on an annual basis based on the qualified energy resource at the qualified facility. As it relates to any one of these, you'll note some of them have asterisks. Those asterisks have a higher rate per kilowatt hour. It works very similar to the 48. There is a base credit, either 0.3 cents or 0.55 cents per kilowatt hour. If you meet prevailing wage or one of the exceptions, that gets amplified at at a multiple of 5 to be the 1.5 or the 2.75 cents per kilowatt hour. Again, domestic content's coming back into play, similar rules. It really focuses on those definitions are heavily defined in the Buy America Act, really trying to focus on, helping create the need for that domestic supply chain. Similar in an energy community, same rules apply, the brownfield, the mine closures. And then, which Carrie will get into in a bit, there is a credit reduction for tax-exempt bonds associated with a bunch of these credits. But we'll talk about the monetization and how you've invested in these or you're producing them. And we'll get into that. Carrie, I didn't know if you had any other thoughts on the production side of things.
Yeah, the one thing, sorry, I was thinking broadly about another question that was being asked. But one of the things, that is available is you, by election, can convert a production tax credit or a Section 45 facility into an investment tax credit. And you would ask, why would I do that? But, it's truly a time value of money approach, that if I think I'm going to get a bigger bang for my buck from a time value money perspective, to convert a long-term credit of 10 years or 12 years in the case of carbon dioxide sequestration, into a dollar value to help me do my facility quicker and convert it into a investment tax credit. That's the economics that we normally have to go through and address and really think of. Really, in your case, this may be better than that. And it really does take some modeling and some understanding behind, your economics as well as, your ultimate facility use. I'll say some parties, like the idea they're going to get some additional amount every year for the next 10 years. That's their pleasure point, let's call it that. They just say, this is what we want to do. This is how, even though it doesn't get this to the same economic basis, we're willing to take the longer term view and just get a little amount over each of the 10 years.
Right. Fair enough. All right. So we're spending the money, we're investing in these qualified facilities, these qualified energy sources. How do we get our money, right? So Like I mentioned earlier, there were 2 new code sections that were added under the Inflation Reduction Act, Section 6417, direct pay, and Section 6418, transferability. So for the most part, you'll probably fall within this 6417. So eligible entities, there's a whole slew of them, but it's tax exempt, it's governments, it's certain electrical co-ops, certain partnerships, S-corps. And so generally, if you're going to own the property, and this is important to understand who owns the renewable property or the eligible property, that's going to trigger if you fall into Section 6417, this direct pay. As a government entity being tax exempt, you're going to fall here owning those solar panels or whatnot. And so the way that we've received preliminary guidance about how to go about it, we're still waiting on more. But generally, it's going to, you'll be eligible for this and you'll be eligible for the credit. There is a recapture period, so you need to hold on to the property for at least 5 years to prevent any repayment of these incentives. But the way that we understand it's going to work is that the IRS is building a registration website. It's not up and running yet. I imagine it'll be closer towards the end of the year, to basically go and say, hey, we invested in some wind turbines. Here's where they're located. This is what type of entity we are. We're looking for these investment tax credits. From there, you'll be issued a registration ID that you'll then use to fill out the other tax forms that you would file either with your annual tax filings. Now, for many of you, you might not have annual federal filings. So there are forms available that you would file as kind of like a one-time filing that you would then use. Similar forms that are used in the for-profit space. There are a slew of investment tax credit forms, general business credit forms that that you would then, attach to this 990T. It's the unrelated business income. And you basically fill out your information. You're going to have your registration ID number, and you're going to check the box to say that you're filing to get this credit back and you're owed your credit amount. So short of other guidance, that's my understanding of how it's going to work. Now, historically, to get some other credits, different government entities use something called a tax equity financing structure, where the tax-exempt organization would be a general partner and you'd have your financial backers be your limited partners and put the cash up front. Now, in that scenario, if that entity is going to own the property, you'll most likely fall into these transferability provisions to allow you to easily sell them. But really, they afforded these code sections to just reduce the reliance, to really get the cash back into the hands of these exempt orgs. And the reason for that is when they looked at who owns these buildings and who has property and who is really going to be investing in, sustainable energy sources, there's a lot of tax exempts out there. When you think of schools, different governments, you guys have a big footprint. And so really to help fund that investment and get the cash back into your hands, they came up with 6417. 6418, similar registration process. You do have to sell it for cash. It'll most likely be sold at a discount. There is some risk involved. The risk transfers, for the most part, it transfers to the buyer, with the exception of the prevailing wage document. The risk is on the seller to keep that documentation. But we've also seen another market within the transferability aspect that a need for a potential tax insurance instrument just to kind of cover any risk should these credits become reviewed. There is also, depending on who your buyer is, there could be a difference in treatment. Passive and active treatments, which is very, very heavy into the weeds on, the taxability side in the for-profit world, but just something to consider if you are looking to sell versus get the cash back here. Terry,
Yeah, I'll add in a statement here. I mean, historically, the flip partnership structure or the tax monetization partnership structure requires, the two parties to at least enter into an agreement, and tax exempts may be available to that structure. The problem with that is it does require the partnership type accounting, and it does require, at least, through the credit period, a clear distinction of who is allocated the credit and after tax rates of returns to be determined, which is the flip is actually determined on a specified return on investment type basis, which is an after-tax return on investment. It's a very painful calculation. It has to be monitored. We talked about, the different credits, so you could be monitoring this for 5 years, 10 years, 12 years, depending upon the credit period itself, that you have to go through that economics analysis to see when the flip occurs. Because of that, most of the historical flip structures were taking, 26 to 35% of the economics of the tax away from the counterparty. So Congress, when they stepped into this, they said way too much is being taken off. That's the reason that they created these two new code sections, is they said, we want a simpler process, a simpler procedure, so that, parties can do this without all of the burdens, that would exist within those historical structures. And they looked to simplify this. Unfortunately, we didn't get them simplified. These are very, the guidance that has been issued on these, has not really said, okay, we let this happen freely without any of the restrictions of the Internal Revenue Code and other provisions that we were hoping to get released. And so that's definitely something, I'll say maybe future guidance will come out where the service provides safe harbors or other ways that people could say reasonable parties entered into this and we expected to get this economics out of it. Is that reasonable? As opposed to the discounts that we have initially saw on the transferability were pretty high, and did not reflect what Congress intended to happen here.
All right. So again, how do you get your money for the tax exempts? That registration process is going to be key. You won't be able to file for these credits without a registration ID or registering the property. A similar process. So both, the commercial fleet and the infrastructure, those credits fall under 6417 and are eligible for direct pay. You'll want to review your annual tax filings, be it a 990, or if you don't have one, understanding you might need to get assistance as far as filing just kind of that one-off 990T. You'll want to document your timeline, the beginning of construction as well as placed in service. And just note that there is that recapture risk when the energy credits are monetized. You have to hold the property for 5 years. So the consequence, and maybe Carrie, you could speak to it a little bit more, but there is an equation that you'd have to figure out how much is owed back to the federal government should a recapture event be triggered.
Yeah, it's actually another taxpayer favorable rule. I always think of it this way, but some people don't look at it the same way as I do. But, recapture is measured on two separate events in this case. If I have an investment tax credit recapture, it is 20% per year. In other words, it is amortized down over a 5-year period. A 5-year is what would be used for depreciation of that property, and that's what they tied it to. So if I have a simple project that I get $100 credit from, and I hold, my interest in that property for the first 4 years, I'm only going to have, I should state there, 4 full years, that I will only have a 20% amount to be repaid back to the U.S. Treasury because I gave up that interest in that property early. It is a 4-year measurement, and they don't let you prorate it on days. So it's something to at least, give consideration to if something happens and you have to dispose of it. Usually what we see is, where you end up trading building A for building B, and thus you have to relinquish your interest in building A, and your solar panels or your other qualified property would go with that building, so you do not have an ownership interest in it. The other thing, to consider is that production tax credits do not have a recapture period. It's not standard in the production tax credit system. So each year I earn the credit by me doing something very specific to meet my energy property definition. I granted that credit, and I have full rights to that credit, irrespective that I sell it to, or do something else with it, to someone else. Now, whether or not that counterparty could claim the credit is the question mark that people have to get into. Have I sold that property to a counterparty that wouldn't meet the original use definition? That can be overcome by partnership structuring issues, but it's separate and a part of this. And I'm going to take a deep breath. We don't have much time.
Yes. All right. So moving right along. So in monetizing all of this, it's also to be aware of just certain financing structures could also impact the total amount available. So I will turn it back over to Carrie to cover this.
Thank you. Okay. So we first are going to a polling question. Great. Are you producing clean energy and selling it to third parties? Yes, no, maybe. This maybe is a good one. So, one of the things which we, just to revisit, we're giving you tons of information. I was going to say, probably at the hour, we should have taken a big break, but, to the extent we've gone past the hour. But, to the extent that you are selling it to third party, that is a condition of a production tax credit, which requires it to be achieved, that I have to sell the electrical power to a third party. Where we end up helping clients is, to the extent that you have access to a grid, you could either utilize that power in your own facility or sell it to the grid and use grid power within your own facilities. That's the question that we have to manage. Can we get to that point? We're at 85% of attendees. So the last parties, if we can get your thoughts quickly so we can.
And just a quick reminder, once you click the button, you also need to press submit to make sure that your response is recorded. Alrighty.
We want to get everybody their credits if we can get them their credits.
Most definitely. Credits of any kind, right? Energy credits, CPE credits.
Yeah, continuing education is definitely something that we're focused on.
Yes, definitely.
We're almost there. 89. As I breathe, we're probably going to respond.
There we go. All right.
Thank you. So one of the interesting things that has come about is, historically, we have gone through this arrangement where if I use my own monies for the project, it means something different than if I use somebody else's money for a project. So we talk about ownership, we talk about the economics of that. Historically, grants from other governmental agencies have been given to this to energy property, energy incentives type arrangements. The Inflation Reduction Act does give not only the authority for credits, but it also gives the authority to other governmental departments and agencies to give money to support renewable projects. And so the question that came up, was, okay, you give me $1, but, somebody else gives me part of that dollar. What do I count for credit purposes? And it was always your net number that you invested, that was counted for the credit. In the guidance issued by the Treasury, specifically for Section 6417 or direct pay requirements, they do go through this, analysis saying, it really is unfair to tax-exempt agencies to be harmed by this, that they're using government money from another source, that they would be impacted by this. And so they basically said, instead of just saying, we're going to turn off that requirement and allow full basis to be counted in that arrangement, they went to this alternative rule that's just kind of like a halfway between the two. And so what we refer to this is the tax-exempt restricted amount. So for that purposes, it does impact or could impact your tax credit to be claimed by the excess amounts, which is simply, saying that it would be your net cash that is invested in the project would be the maximum amount of credits that you can claim on that project. And so we're going to walk through, 3 examples, just quickly. I'm happy to get all the questions in the world that we can cover in this area, but I'm going to walk through this quickly and say, here's the facts of this equation. I've got a school district that wishes to update its fleet. EV buses, cost about $400,000, which grants could be available from the Department of Environmental Protection Agency. The purchase price of the bus is $400,000. The grant amount, in this case, if the Environmental Protection Agency, we want you to do it, we really want you to do it, and we're willing to pay for it. They give you a $400,000 grant amount for your purchase of that EV bus. The credit would be calculated this way. The credit is maxed out at $40,000 per vehicle. I refer to this as the tentative credit because my purchase price was $400,000. The grant amount was $400,000. The school district has zero invested in that EV bus. Thus, I get no credit allowed. Now, you could say, absolutely horrible. Why would they do that? But think of the economics here is, it costs me zero for the investments of this bus, So it didn't cost me anything. I got a new EV bus without having to do anything at all. I'm not going to be able to take a tax credit. I'm just going to basically get my free bus as provided by the Environmental Protection Agency. I'm going to modify that example with this example. Let's say instead of a full grant for the amount of the Environmental Protection Agency is only going to give me $300,000. So I'm going through the same economics again, that says, I've invested $400,000, but my grant amount is $300,000. The school district has cash in the program of $100,000 for that bus. So $100,000, I still base the amount of the credit on the purchase price and not the net amount invested, but in this case, I've still maxed out. It's a $40,000 per bus that would be allowed. the economics of this means the school district only has $60,000 after the tax credit invested in this. So you got a $400,000 bus for $60,000 net cash of the school district out. Everybody understands that. You know, you may not agree with it, but you can understand it. We're going to even go to a more complex to give you some of the things we normally have to think through. So instead of buses, I'm going to go to a solar farm. In my case, the solar farm is estimated to be $2.2 million of total costs. The qualifying assets would be the $2 million. The non-qualifying assets would be $200,000. That, you know, in my example is, you know, the lands for the facility, you know, transmission or any other land improvements that don't qualify for the credit, you know, to get that facility up and running. So what that simply comes down to is that I, you know, am trying to calculate, you know, the amount of credit that could be available with, you know, a grant that is provided. And I'm just going to say a governmental agency of some nature is willing to go, you know, to a 25% credit, 25% of the grant amount on the total cost of the facility. So in my simple example, that is $550,000. So the tax credit that could be available is the 30%, you know, with consideration to domestic content as well as energy bonuses. Just still, those all are possible. To the extent that I've got consideration here, I must go through an analysis of what is my qualifying cost, you know, for the facility that would be available for the investment tax credit. We refer to that as a cost segregation type calculation. I'm going to look at the grant provisions of the grant and say, could I push any of this cost to non-qualifying assets? If the grant is very specific to say solar and solar only, then I'm going to have a different calculation. Then the grant would say, you know, for your project broadly described, all this would be available. Also, I'm going to introduce something that, you know, from the tax world, we refer to as uniform capitalization provisions. So to determine the uniform capitalization provisions, it is to make an understanding of what the full cost of that. Uniform capitalization allows me to bring not only direct costs of my solar facility into account, but also indirect costs that are associated with development of that solar facility. So back office costs is what you might think of in this. My example here is a lot of calculations and formulas, but I'm going to walk you through very simply in saying, you know, so my total cost with the indirect cost of the facility has now gone up by additional $100,000. And so my full cost of the facility is $2.3 million, of which I'm going to allocate, just mathematically allocate between my qualified and non-qualified, those indirect costs. That increases what is available for the credit by, you know, an additional amount of money. You know, part of my $100,000 would be assigned. My grant amount is 25%. The grant was not specific, so I'm going to allocate the grant across both qualified and non-qualified assets to give me an investment tax credit of 30%. You know, on the amount of qualified costs, so that comes down to $627,000. Not going to run with the pennies. I could get domestic content. The domestic content is also calculated on my $2,090,000. My energy community is also going to be calculated on that full cost arrangement. So it's also $290,000 available. So it gives me a tentative credit of $1,045,000. government considerations. Government considerations is the combination of the amount of funds coming from my grant as well as the investment tax credit to be considered. So in this case, I'm simply saying it is going to be $1,500,000, plus change, that would be available for government consideration, because that brings me to a tentative investment by the city of only $545,000. I'm going to have a clawback of the investment tax credit that could be allowed. So I'm off my $1 million, and mathematically I've given you this calculation to say economically what I'm doing is taking the amount of investment, let's call it the amount of government consideration plus the amount of investment by the city, and I'm going to divide it equally. It's a circular calculation, but I'm going to get to the circular calculation by simplifying it and just coming it down and saying that effectively I'm going to go to a net investment tax credit allowable for consideration under this provision to be rounded up $800,000 of refunds that could come from section, the direct pay provision under section 6417. Sorry, I didn't hit. Let's go back. Unfortunately, I didn't do that very well. Anyway, so here's the calculation that what I just verbally described. Sorry about that. We have another polling question. How are your capital improvements financed? Is it municipal bonds, state and local grants, commercial lending, donations, or a mixture of the above?
All right, and while we wait for responses to come in, we have a couple polling questions. Gary, first, how would a lease purchase for a solar project affect the ability to submit for the investment tax credits?
Okay, we're glossing over a lot of rules here simultaneously. But, specifically, I think, the example, that I've laid out is really the ultimate thing that would be submitted to the Treasury Department or to the IRS specifically for calculation. We do not know what they're going to ask for here. Historically, we had a program that is referred to as Section 1603, where this went through a similar type approach. And the amount of information actually in that case was being asked by taxpayers to be submitted to the Treasury was a lot of information. We're hoping a simpler approach where you would indicate the amount of credit that would be available, by a calculation of how you did your credit, your name, address, any other information to identify the project by project area and the like. So all that is going to be submitted, with any other requests the Treasury will come up with that they think is necessary to keep, tax fraud from occurring, a big concern for everybody. But But, effectively what we're trying to tell people is that it is a complex calculation of which, you might, sit down and give consideration to on how you present that calculation to the government website that would be filed for this purpose.
And so for a lease purchase, I think it's going to look to who owns the actual property, right? So
I could talk about leases. Yeah, I mean, we should have talked about leases. Lease arrangements come down to the definition of true release, which is a tax terminology. What a true lease means that really that economics of the ownership must occur through the tax life of the project. And so under a lease arrangement, what actually happens is the buyer, the lessor actually buys the property from the tax-exempt party and then runs it through a payment schedule, that allows the tax-exempt party to pay them back under a lease schedule. The economics of those sometimes are better than other, traditional leases, but it does require the tax-exempt party to repay. The one requirement I always tell people is that, it has to run through the tax life of the project, which in our example of a 5-year project, it must run through the 5 years. If it is another tax provision that would establish its tax life, we would have to run it through that longer period.
All right, so just a quick reminder on the polling question, trying to get to 90%. Make sure you hit submit after you select your answer.
Can you guys hear me okay?
Yes.
Perfect. Thank you, Colette. And also remember, you can download the PowerPoint slides in the related content box. Go ahead and click on PowerPoint handout and you'll be able to download the handout.
Then one more question, how do municipalities claim the Section 45W credit? So that is similar to that direct pay option. So if you don't have an annual tax filing, there's that 990T that you'll be attaching a series of forms to. And so that's where you'll need some tax guidance for there if you're not used to filing forms with the IRS on an annual basis. The forms themselves have not been updated to account for these credits, so that is something to be aware of. Typically, we see forms get updated right at the end of the year or kind of the beginning of the tax filing season. There is a bit of that, of a delay in timing, right? So you would file for these credits after the year end is wrapped up. All right, so with that, we'll turn it over to Joe to talk about the 179D energy efficiency deduction.
All right. Thank you, Colette. And thanks, everybody, for sticking with us here for an hour and 43 minutes and counting. A lot of dense information, but I think it's really, really good. And as Colette mentioned, at $2 trillion, up to $2 trillion over the next 10 years, $200 billion a year is certainly enough to at least explore a number of these provisions. And if you haven't ascertained from the last hour and a bit, obviously quite complex. It's almost as though, Congress set this thing up with the help of the Treasury of the IRS. So more to unpack than it's probably typically reasonable for any individual. So I obviously encourage you to reach out to your tax professionals. Obviously, I, Bailey, can help if that's something you're interested in. But there is a bunch to unpack, and obviously the devil is in the details. So in any event, we've got a few minutes left here. We'll run through the Section 179D energy efficiency deduction. So this is a variation on the theme. The 179D, it's not a new concept, similar to Section 48 where it's been around, although not as long as 48. 179D, courtesy of the Energy Policy Act of 2005. So it's actually been around since January 1st, 2006. So what we'll do here in the few minutes we have remaining is just kind of hit on some of the high points, juxtapose kind of pre-IRA rules versus post-IRA rules, and see where it's going to be applicable for your departments. So 179D deduction of up to $5.36 per square foot. And again, that is effective 1/1/23. Previous to the IRA, 179D was indexed to inflation at $1.80, right? So in 2022, the deduction is $1.88 per square foot. Now, Section 179D, it is similar to a 48 or 30C where we're installing some specific piece of energy property. What 179D does is it looks at the building as a whole and juxtaposes or compares it to a reference building based on the ASHRAE 90.1, typically the 2007 standard. So from a practical matter, the energy efficiency requirements to qualify for this deduction is really quite low. It's actually a modified 90.1 standard, whereby we are only looking at the energy efficiencies of the mechanical systems, the building envelope, and the lighting. So all process and plug loads are pulled out of the equation. Elevators and the like are both pulled out of the numerators of that equation. It actually makes it even more easy to qualify for the full $5.36. In 2027, it's scheduled to bump up. The energy efficiencies are scheduled to bump up to the 2019 standard. We'll see what happens there, but so far so good. We've got a good runway here to make our planning. So in terms of, just similar again to a direct payment from Treasury, this is a situation where it's monetized by your designer. Let's just walk through that very quickly. Before we do that, sorry for the misclick. You'll see as you Google around, you'll see the 179D deduction. It applies in two ways. If you talk about monetization, if we are a for-profit entity, just is interesting information. If we're a for-profit entity owning a building, then I, as the building owner, can take that deduction. We can go all the way back to 2006 and claim that deduction every 3 years, assuming there are qualified activities. Now, a couple of interesting things specific to this group. Designers for tax-exempt entities are eligible for this deduction. And the big change here is this now deduction can be allocated every 4 years. And historically, it has been a one and done. We built the building in 2006. We built the school or the courthouse in 2006. We did a 179D study, and that was it for the end of the building. Now, if we build the building in 2006 and our designer does a 179D study, and we make some modifications or improvements and qualifying activities, on or after January 1st, 2023, that deduction can now be allocated again. And looks like we're at polling question number 7. Polling question number 7. Have you been asked to allocate a Section 179D deduction prior to 2023? Yes, we signed it. No, yes, but we didn't sign it. No. And geez, I can't remember.
All right, everyone, please make sure you are answering these polling questions. If you are here for CPE credit, make sure your slides box is maximized so you are able to see the polling question. You'll make your selection right on the screen, and then you'll scroll down just a bit and hit submit. Please make sure you are submitting your answers so you get your credit.
Okay. Looks like they're still rolling in here. 212 people stuck with us for an hour and 50 minutes. That's amazing. Thank you so much.
Hey, Joe, there's a question. I'm not sure
okay.
if you've already answered it, but it says, do clean vehicles include electrified trains? And maybe that's more of a Colette or Carrie question.
That feels like a Carrie Gordon question to me. And to be honest, I am not sure.
Yes, yeah. I'm willing to try to answer this one. Traditionally, it was vehicles that go over the road, roadways referred to as highways or infrastructure. However, you know, this is different than what was available, you know, under the energy fuel provisions, you know, where they allowed you to, you know, have clean energy on trains themselves. So the investment tax credit that is available under 45W does not take that into consideration. So the current answer is no. You know, that may be something they would have to revise or give consideration to. But, you know, that definition of a vehicle over the road is the troublesome part.
Gotcha. Thank you, Carrie.
And there's one more.
Go ahead. I think we were saying the same thing, Colette, there, but another question that came in, does the credit apply to both the cost of the material and the installation of the credit items? Gary?
Okay, that is the full cost, you know. So if I buy a vehicle and I go through all of my, vehicle, if I buy a unit and go through all the installation of that, including, you know, wiring and, you know, anything to tie it into a system, that is the full cost of that. So we talked about the direct and indirect, that cost of installation, delivery, transportation, installation, shipping, and all those factors go into its direct costs.
Perfect. Thank you, Gary. As we mentioned, we're looking at an applicable standard of the ASHRAE 90.1. Really what we're hoping to find in a Valhalla state is we're 50% or more efficient in one of these energy efficient commercial building property categories. Again, building envelope, mechanical systems, which includes heating, cooling, as well as hot water, as well as the interior lighting system. The question we get quite often is like, gosh, we're replacing our parking lot poles with new LED lights. Would that possibly help with the 179D deduction? Unfortunately, in this context, it does not. What we're looking for in 179D is specifically within the building envelope. So 4 walls and a roof and everything inside. There you can see the deduction is on a sliding scale, starting at 25% savings, and then again, all the way up to 50%. Similar to a number of the other provisions that Carrie and Colette were mentioning, we're looking at we have a base credit, or in this case, a base deduction of X. And if we adhere to some prevailing wage and apprenticeship requirements or fall under a safe harbor, that incentive deduction 5Xs itself. So you can see if we're at 25% more efficient, then we have a 50 cent deduction. But if we're doing the prevailing wage apprenticeship, we're at 5X. So this, like I mentioned, this is an incentive specific to your design team. Right? So designer could include an architect, mechanical engineer, electrical engineer, a building contractor, could even be a subcontractor, assuming assuming those folks have played a role in creating the technical specifications for the installation of the energy efficient commercial building property. So the question is all right, we, the architect, meet the definition of a designer in this context. How are we able to take advantage of this deduction? The way they are able to pursue it is through something called an allocation letter. You can see a generic example on the screen there, and this is the mechanism that allows them to obtain the deduction. Very specific verbiage and pieces of data that needs to be on said letter, and this is typically completed by your architect or their third-party consulting firm, and it's signed by them and countersigned by you. So in order for them to take this deduction, it's imperative that they acquire or secure a signature from someone at your organization who has a working knowledge of the building and can confirm a number of these pieces of data. This allocation is at your sole discretion as to how you allocate the deduction, assuming you are allocating appropriately to only those who meet these designer definitions. And obviously, we can only assign up to, in this case, a $5.36 per square foot deduction. Oops. There we go. Here you can just see a very quick case study in terms of the monetization by an architect. So on the top, you can see the project summary, about a 95,000 square foot building placed in service next year. Because we began construction prior to January 29th, 2023, we fall under the safe harbor, meaning we do not adhere to the prevailing wage and apprenticeship rules, and we're going to qualify for the entire incentive. In this case, a $5.36 per square foot deduction. On the design team there, you can see anonymized designers. Those are the three in this particular project that would qualify as a designer. In this context, the general contractor and their subs did not play a role in creating the technical specs, so it would be inappropriate for them to take advantage of this deduction. And down at the bottom there, you can see the kind of the gross designer benefit. Again, we are going to be at that bonus deduction of $355 to $528. Assuming they're on a marginal tax rate of 30%, the gross benefit to the designer is $106,000 to $158,000 in this context. Obviously, overly simplified, but you get the idea as to how that works. I will mention there is a brand new form out there starting in 2022, which we'll see for at least the next 10 years. Form 7205, this is now required. It's cut off at the bottom. The reason we mention it is because it will actually list the individuals who are signing the allocation letter, both on the governmental entity side as well as the designer side. So it's imperative that whomever is signing these allocation letters are doing it appropriately. And whomever's filling out this form knows kind of where the numbers go and what the verbiage is needed. The good news is this 7205 is a derivative of something called the certificate of compliance. So the data is readily available. It's just a matter of making sure we dot the I's and cross the T's from that perspective. Very quickly now on kind of the mechanics of this 179D deduction, the exempt org, state and local government, will allocate that deduction through the allocation letter to the designer. The designer will then engage a third party, typically a professional engineer. As an aside, Eide Bailly, it's a little bit different, but Eide Bailly is a professional engineer licensed in all 50 states. And they would engage Eide Bailly to complete a study for them. It's a situation where even if the architect has professional engineers on staff, it needs to be an unrelated third party. You can't grade your own work. So we would need to create those energy models using the DOE and IRS approved software, create the certificates of compliance and the like. Oftentimes we're seeing this more and more as the rules become slightly more cumbersome, is oftentimes the governmental entity will ask us to help with a little bit of consulting work. Just, are we allocating this deduction appropriately? Do we have all of the paperwork in order? That's certainly something we can help with. And then finally, you can see kind of going back the allocation credit. Typically what we're seeing happen is these negotiations, or the signature of the allocation letter is done kind of at the contract negotiation phase, right? Architect, you are going to draw up these plans for us. We know for a fact, or we will allocate this deduction for you. Maybe there's a situation where we might be able to sharpen our pencils and get a slightly better pricing on our services. So the interesting thing, and Colette and Carrie touched on this quite a bit, is with all of these, I shouldn't say all, with the majority of these Inflation Reduction Act incentives, they are stackable, right? Meaning one doesn't necessarily take away from the other. Obviously, we've got the investment credit and investment tax credit and production tax credit, which, you know, they've got an interplay in there. But if we go back to that thermal storage question, yes, we can certainly qualify and get the Section 48 ITC as well as the Section 179D. So very quick behavioral health center. We're going to get the clean energy investment tax credit through the thermal energy storage property, a direct pay to the governmental entity. And then they will also assign a 179D deduction to, in this case, I believe it is the mechanical engineer. So as we come to the top of the hour, we'll leave with this, although happy to hop, I think Carrie and I and Colette are happy to stay on the call or circle back around with any additional questions. The question, whether it's 179D or 48 or anything, the obvious question is like, we have something that we think might qualify, or we're planning something that might qualify. What do we do next? Certainly not a sales pitch, but the tack that Eide Bailly is taking is the first step is always to kind of just go through a discovery call and talk through the specific fact patterns of any particular project. Typically takes 45 minutes. And at the end of that call, it's immediately apparent as to if it makes sense to enter into phase one agreement. If that's appropriate, then we will we'll do that. And that's typically an hourly, not to exceed some amount of money where we're able to dashboard and quantify and identify those opportunities for you. And then from there, depending on what the results of the phase one are, then we can help implement the tax credit when with the understanding that we're still waiting on quite a bit of data and information in order to do so from Uncle Sam. Looks like we have one final polling question here, just in case anybody missed it. Would you like a member from our team to reach out after the webinar? Yes, please, or no? Thank you.
Thank you, Joe. All right, everyone, we are at the end of the webinar. If you did miss a polling question, you can still answer this last polling question in order to get your CPE. If you have met your CPE requirements, you will see that on the right-hand side in the certification box. You would be able to view your certificate from there and download your certificate. If you have any issues with your certificate, you will be receiving a thank you email. You can respond right back to that thank you email regarding your certificate, and we will be able to take care of you on the back end. Alrighty, and with that, I would like to thank everyone for joining us today on this webinar and thank our awesome presenters for giving a awesome educational webinar. And with that, I will leave everyone to the rest of their day. Have a great rest of your day and have a great upcoming weekend. Thank you, everyone.